we're going to learn how to prepare journal entries for a manufacturer's job costing system. We're going to talk about all these entries that you see. However, I'm going to show you it in the form of T accounts because it's easier to see the flow of costs using T account. Be sure to know what a journal entry is, and I'll show you one journal entry so you can remember that, refresh that from accounting 1. But be sure to know all the journal entries and the T accounts for manufacturer's job costing system. First, let's take a look at purchasing of raw materials. Assuming you purchased raw materials on account, whenever you purchase raw materials, you debit your raw material inventory account and you credit your accounts payable. Now next, let's take a look at what we would do when we use direct materials. In this case, the two accounts affected are raw material inventory and work in process inventory. Remember that direct materials are traced to the individual product. So whenever we use up direct materials, what we do is we take it out of our raw materials inventory and put it to our work in process inventory. So what we do is we debit work in process inventory for direct materials used, and we credit raw materials inventory for the same amount. Remember from accounting 1, your debits always have to equal your credits in a journal entry. Next, let's take a look at the use of indirect materials. If you remember, indirect materials are materials that we use during production that cannot be directly traced to the product. Indirect materials are part of manufacturing overhead. So the two accounts affected in this case are raw materials inventory and manufacturing overhead. You debit manufacturing overhead for the indirect materials used, and you credit raw materials inventory. So you take it out of raw materials inventory and then it goes into manufacturing overhead. When you're taking notes in this section, you can probably use different colors for each journal entry. That way it's easier to keep track of the two sides of a journal entry, because each journal entry adds to items, transactions that are already in that account. For example, raw material inventory now already has 3 items. If you have them in 3 different colors, it'll be easier to follow along. Next, let's take a look at the use of direct labor. Again, if you remember, direct labor can be directly traced to your product. In this case, the two accounts affected are wages payable and work in process inventory. As you know, work in process inventory already has direct materials used. Remember, work in process inventory is where we keep track of all the direct materials, direct labor, and manufacturing overhead once product is in production. So direct labor, as it's used up, or rather as people work, direct labor also gets accumulated into your work in process inventory account. Your journal entries that you debit your work in process inventory and then credit your wages payable account. Let's take a look at the use of indirect labor. Indirect labor is labor that is used in the factory, such as a plant manager's wages or a janitor's wages. It's still factory costs, however, they cannot be directly traced to the product. They are again a part of manufacturing overhead. The two accounts affected are manufacturing overhead and wages payable. What you do is you would debit your manufacturing overhead for the indirect labor and credit your wages payable for the indirect labor costs. Now let's take a look at the journal entries when we incur other manufacturing overhead costs. This section is a little complicated, that you need to know that what we're recording here is the actual overhead costs that occur during the year. So this is different from the allocated manufacturing overhead that we put to our work in process. This is actual overhead that you incur during the year. So your actual utility bill, actual indirect rate, actual depreciation expenses for the year, all these are going to be debited to your manufacturing overhead account. Now where they get credited will depend on the particular type of cost. Let's say if it's a electric bill or utility bill, you would probably use accounts payable. So you would debit your manufacturing overhead account and you would credit your accounts payable. Then you may have things like plant depreciation, depreciation on plant equipment. For that, you would debit manufacturing overhead for the depreciation expense and you would credit your accumulated depreciation for your plant and equipment. You may have insurance, plant insurance. You would debit your manufacturing overhead, and if you paid your insurance in advance, you would credit your prepaid insurance for the amount of insurance used up. So this is journal entry to record incurring manufacturing overhead costs. Next, let's look at what the journal entry to allocate manufacturing overhead to jobs as it occurs. Whenever we are allocating manufacturing overhead to jobs, the two accounts that are affected are manufacturing overhead and work in process inventory. If you notice in your manufacturing overhead account, you see all the entries we've done before. Those are our actual overhead costs that were incurred during the year. But if you remember, how do we allocate overhead to individual jobs? We trace our direct materials, we trace our direct labor, which we have both done in our work in process inventory account, but we allocate our manufacturing overhead. To allocate manufacturing overhead, we calculate how much overhead should be allocated, and then we allocate it by debiting our work in process inventory and crediting manufacturing overhead. Let's take a look at the journal entries when we complete our jobs. The two accounts affected are work in process inventory and finished goods inventory. When we are completed with our jobs, we transfer it out of work in process inventory to our finished goods inventory. So what you would do is you would debit your finished goods inventory for the cost of goods manufactured, and you'd credit your work in process inventory for the cost of goods manufactured. Now let's take a look at the journal entries when we sell our products. Whenever we sell our products, and this time remember we're selling inventory, there are two entries, or there are the two transactions for every sale. There are four accounts that are affected, and those four accounts are sales revenue, finished goods inventory, accounts receivable, and cost of goods sold. Sometimes it could be cash, but we're assuming that our sales are on account. So let's see what the two transactions are. The first transaction is the actual sales. Whenever you sell a product, you would debit your accounts receivable and you would credit your sales revenue. The next transaction is recording your cost of goods sold. Cost of goods sold comes out of finished goods inventory and goes into cost of goods sold. So you are going to debit your cost of goods sold and credit your finished goods inventory for the cost of your goods sold. Next, let's take a look at other operating expenses. This time, we're going to take a look at an actual journal entry. This is where you would record all your non-production, non-manufacturing costs incurred during the month. So examples would be sales salaries or regular head office salaries and other commission expenses, those that you would debit, and you would credit the respective payable account. Rent expenses, again, you would debit how much you would pay for rent and credit your rent payable. If you have marketing expenses, you would debit marketing expenses, credit accounts payable. This is very similar to all the journal entries you're used to in Accounting 1, so we're not going to get too much into operating expenses in this course. Finally, let's take a look at the journal entries involved in closing out manufacturing overhead. If you remember, we talked about manufacturing overhead. On the debit side, you have the actual manufacturing overhead incurred. On the credit side, you have manufacturing overhead allocated. But as we said earlier, manufacturing overhead incurred and allocated never ever is the same, because overhead incurred is the actual amounts incurred. Allocated depends on a calculation that we used estimates for. So what do we do in this case? We have to close out our over allocated or under allocated to our cost of goods sold. If your manufacturing overhead incurred is greater than your manufacturing overhead allocated, that means you have under allocated manufacturing overhead. Your incurred amount was more than what you allocated, so you didn't allocate enough overhead to your jobs. We have an under allocated manufacturing overhead and our jobs are undercosted. In this case, our debit side is greater than our credit side, and we have to close out our manufacturing overhead. The difference has to go to cost of goods sold. So in this case, what we would do is we would debit cost of goods sold and credit manufacturing overhead for the amount of under allocated manufacturing overhead. In this situation, the cost of goods sold increases because we're putting this journal entry on the same side as cost of goods sold. Let's take a look at the reverse situation, where manufacturing overhead incurred is less than manufacturing overhead allocated. In this case, we've over allocated manufacturing overhead. We have allocated too much overhead to jobs. In this case, our credit side is more than our debit side, and in order to close out our manufacturing overhead, we have to debit our manufacturing overhead for the amount of over allocated overhead and credit our cost of goods sold for the amount of over allocated overhead. This scenario results in our cost of goods sold being decreased by the amount of the over allocated overhead. Be sure to review all your journal entries and be ready to reproduce them when we go through them in class.